Money and the banking system. Now, in this lecture, we are going to first of all look at what money is, how to measure money, how banks create money, and finally, the money multiplier. So, let's start with the first part where we are going to split it into two. We will talk about what money is, what are the four functions of money. So, let's look at what money is. Money is anything generally accepted in the exchange for goods and services. So when you go to the market, remember in economics, a market is any arrangement that enables buyers and sellers to come together and exchange goods and services. And what you use in the exchange of goods and services is money. So it has to be generally accepted in the exchange of goods and services. That is what money is. Before the monetary system we presently know, people used to use commodities in the exchange of goods and services. For example, people used playing cards, furs, and cigarettes. However, the problem is that these different types of money were simply not durable, so that was not helpful. Now you also had what is known as trade by barter that we'll briefly talk about in a few minutes. Now, what are the four functions of money? Money, as we know today, is first of all a medium of exchange, a measure of value, a store of value, and a means of deferred payment. Let's look at each of them in detail. So money as a medium of exchange. The primary function of money is to facilitate transactions and to lower transaction cost. What do we mean by that? When you go to the market, what makes things really easy is when you have a common denominator. You can value the goods and services in terms of a common factor, which is money, and that makes exchange really easy. Else, it will really be difficult. For example, if you want to buy, let's say you need meat, and then you have oranges to exchange. How do you determine the amount of oranges that is equivalent to a certain amount of meat? And you also have to meet someone who has oranges and wants meat. It's really challenging to do that. Now, in the absence of money, people will barter. In other words, they will exchange goods for goods, which is simply, so barter is the direct exchange of goods and services without the use of money. So money really facilitates transactions on any market. Now, you can see that the barter system is simply inefficient because at times you need to perform several trades in order to obtain the desired goods. For example, if you want oranges and you have apple, it means you need to find someone who has oranges and who needs apples. Maybe you have to exchange your apples with something else that the person who has oranges actually needs. That makes it very confusing. And of course, it's also very expensive over long distances. But when you have money, which is generally accepted, you can now do that transaction. So we come back to the first one, which is money is a medium of exchange. It facilitates transactions. The second one, money as a measure of value. It simply helps you to be able to compare things. For example, going back to oranges and apples, how do you determine the amount of oranges that is equivalent to apples? Now, you can convert everything into money and then you use it to determine how the exchange has to go. Now, moving on to the next one, money as a store of value. How do you store something valuable over time? For example, you have oranges. How do you store that over time and maybe pass it to the next generation? Money makes that really easy. Money provides a means of saving or accumulating purchasing power from the present and transferring it to the future. Else it will not be possible. You'll just have to use all the goods you have now, especially if it's perishable goods. However, you are able to transform your perishable goods into money by going to the market, performing a transaction, getting money, and then storing it. So it is a store of value. And of course, a means of efficiently saving things of value is by converting it into money. Now, moving on to the fourth thing, money is a means of deferred payment. So if I need a loan today and to repay in 1 year's time, how do I get your oranges, and then in 1 year's time, how do you really determine, are my oranges as big as your oranges were? It becomes a bit confusing. So the attribute of money makes it really easier to borrow and to repay loans, because money, you can determine the oranges, it's worth this particular value, and when you're paying back your loan, you pay the same amount of money, of course with interest. And of course, the value of money fluctuates less than the value of other commodities. Now, let's move on to the second part of the lecture, which is measuring money. So let's start by, what is currency? When we talk of currency, what do we mean? Currency simply consists of coins and banknotes. This is very important to remember. Currency consists of coins and banknotes that an institution or government has created to be used in trading. Now, note that the currency that is used in one country may not be the same used in another country. The government of that country determines what should be used for the exchange of goods and services. That's what currency is all about. So in Canada, we have coins and banknotes used in transaction. Let's look at the next term, legal tender. Now, legal tender simply refers to the coins and banknotes officially declared to be acceptable for the settlement of debts incurred in financial transactions. So if the government has declared that the Canadian dollar, the coins and the banknotes, that it's legal tender, it means if I go anywhere to buy something, they have to accept the Canadian dollars. I cannot go to Tim Hortons along St. Catherine and someone says, no, we are not accepting Canadian dollars. They have no choice. They have to accept it because it is legal tender in Canada. However, if I take out euros, they don't have to accept it. They may. That is a very private decision, because euro, that is not legal tender in Canada. However, the Canadian dollar is legal tender, so they have to accept it in the settlement of debts or in transactions. Now, the concept of fiat money simply means it is a means of exchange established by government declaration. So the government declares this is the means of transaction. You call that fiat money. And remember, legal tender is simply fiat money, because it is the coins, well, it's currency. It is the coins and banknotes that the government has declared as being legal tender. So legal tender is just fiat money. Now let's move on to the next item here. What are demand and saving deposits? Now this is also a very important term, because when we start looking at M1, M2, then this comes handy. So what are demand and saving deposits? If you have a bank account, there is what we call a checking account in Canada, whereby you keep your money and you can access that money at any time. You use it to pay transactions. So demand deposits, this is just a balance in your bank account that the depositor can access on demand. So if you simply use your debit card or you go online, you can access that money instantaneously. So it can be used by simply writing a check or using a debit card. You access it on demand. They can, of course, be converted to currency on demand. What do we mean? You can go to the counter and say, I want $100 from my checking account or from my demand deposit. They will give it to you in coins and banknotes. Remember, we said currency, we are looking at coins and banknotes. They will convert it into that and give it to you. Now, demand deposits have replaced banknotes and metal currency. So remember, demand deposit is just here, it's your checking account. And you can go and access that money and say, give it to me in currency form. In other words, in coins and banknotes. Now, we are saying that people no more use coins and banknotes very often. They just perform their transaction directly from their demand deposit. So here we are saying that demand deposits have replaced banknotes and metal currency as the major source of money used for large transactions. So people will rather just perform the transactions directly from their demand deposit. Why do they want to do that? Because it is easy and safe. You don't need to be carrying money around. You can just sit on your computer or be on your phone and perform your transactions. So it is less risky than currency. There is also lower transaction cost, and of course it's a convenient way of doing business. It can be very useful for tax purposes. Why? Because there is a trace. Whenever you do something online or from your demand deposit, there is always a trace of the transaction. However, when you pay things cash, if you don't get a receipt, then it's very difficult for you to prove that for your taxation. Now, when we talk of credit card, this is simply a guaranteed loan available on demand. So credit card is not money, but it's just a convenient tool for carrying out transactions. And of course, you still have to ultimately, if you buy something using your credit card, it must be paid for with a check or online money transfer. You have to pay for it at the date set by the person who issued the credit card. So credit card is not money, it's just a convenient way of paying or of performing transactions. On the other hand, your debit card is also not money. However, it provides easy access to money in your checking account or in your demand deposit. You can use your debit card to instantaneously access that money, use it for transaction. So it debits your bank account directly when you use it. Now, let's go to electronic payment. Electronic payment is simply an online service which allows you to transmit your payment electronically. That's really it. And the saving deposits, remember we are talking of demand and saving deposits. Saving deposits, this is simply where the idea behind saving deposits is that you keep money there and it generally yields interest. You cannot directly use it for payment. So you cannot use your debit card to pay something directly from your savings account. Some banks may allow that, but most of the time you will have to transfer it from your savings to your demand deposit, and then you can access it easily. So that's what generally happens. So let's take a look at money market mutual funds. So this is simply, when you see mutual funds, it means people have put money together and the money is generally used to be invested and it bears interest. So this is interest earning account provided by brokers who pool funds into investment. So you have an account where people can put funds in it. Well, you also put funds in an account provided by a broker, and the broker uses that money to invest. Now, you can get that money pretty fast, but here we say it's highly liquid, but not technically considered money. You cannot just use the money which is there to buy goods and services instantaneously. It takes a bit of time to convert it into something you can use directly to buy goods and services. Now, when we look at stocks and bonds, stocks, it's just a piece of paper showing you own part of a company, and bonds, it's like an IOU paper where someone says, okay, I'll pay you this amount of money with this interest at a given period of time. So these are financial assets that take time to convert to cash. So you still have to sell the stocks and you still have to sell the bonds to be able to get the money for your transactions. And of course, it fluctuates in value over time. For example, bonds really fluctuate with changes in interest rate. Stocks fluctuate based on the expectations of investors vis-a-vis the stock or the economy. Now, it's not generally considered money. We want to look at the concept of liquidity. When we say something is liquid, what do we really mean? We are simply looking at the ease with which one asset can be converted into another asset, or generally be converted into goods and services. So money you have can easily be converted into goods and services. Actually, it's instantaneous. If you go to buy gas for your car, you just give money and that's it. You can convert money into gas or convert money into something else. So that's the idea behind liquidity. If they say something is highly liquid, it means it's very easy for you to convert it into goods and services. Now, money is the most liquid of assets because it is easily to convert money into goods and services. So goods and services is really the measure. So when you get into transaction, it's all about the exchange of goods and services, and money really helps into that. Now, how is money supply measured? So generally in Canada, we use M2, well, in most developed economies. We look at M2, and in Canada, we do M2+. Now, what do we mean by M2? M2 consists of currency outside chartered banks. Now, when we say currency, we are looking at the coins and banknotes. So these are the ones which are outside chartered banks. For example, out of TD, out of Banque de Montréal, out of RBC. They may be in your pocket, in your wallet. They may be somewhere with the cashier in your cash registry, but they are not with banks. So we are looking at currency outside chartered banks, plus demand and saving deposits. So when you talk of demand, you are looking at the money in your checking account and money in your savings deposit. So we are looking at the combination of currency outside chartered bank plus demand and saving deposits at chartered banks. So this is considered M2. Then when we go to M2+, so generally when you are thinking of money supply, you think of M2. Now when you think of M2+, you are looking at M2, so all of this, plus demand and saving deposits at other financial institutions different from chartered banks. So when we think of chartered banks, think of institutions like RBC, TD, Bank of Montreal. When we talk of other institutions, we are thinking of trust companies, we are thinking of mortgage loan companies, credit union, Caisse Populaire, and other financial institutions. So all of them will give you M2+. So if you want a more comprehensive definition of the supply of money, then you have to put all of that together. And here, if you take a look at this is sourced from Statistics Canada. You can see the currency held outside chartered banks. You can see the demand deposits and savings deposits at chartered banks. Then the combination of that, the sum of that gives you M2. Now, if you also add the deposits and, well, the demand deposits and saving deposits, so all the deposits at other financial institutions, you now have M2+ for the sum. And you can see how across time it has been increasing just because the amount of transactions or the demand of it has increased over time in Canada. So until 1929, Canada was on an internal gold standard, which is simply a monetary system that defines the value of money or the value of the dollar, the Canadian dollar, as equivalent in value to a certain amount of gold. So you had to say $1 or $100 is equivalent to this amount of gold. Why? Because the value of gold doesn't change so fast. So you had to peg or attach the value of the dollar to that amount of gold. In other words, if you take that dollar and go somewhere, they should be able to give you, well, the value is equivalent to that amount of gold. You should be able to command that amount of gold if you go to the central bank, and the central bank generally had to keep that amount of gold. But after that, that was completely changed, and we moved on to a completely different system. So why do people even accept to use money? All that is coming from the faith that people will take it for exchange. You will never go and accept money. For example, if you are working somewhere and they give you money, why will you take that piece of paper? It's because you trust that when you receive that piece of paper, when you go somewhere and give that piece of paper, they will accept it in exchange for the goods and services you want. So it's really based on the faith of the people. In other words, our money is money because of the confidence that we have in private institutions as well as in our government. That government will accept it when you are paying taxes or things like that. Now, of course, here we are more or less saying the same thing. What makes this money valuable? Banknotes are valuable if they are acceptable to people who want to sell goods and services. Else, then it's not worth it. Let's move on. We will move on to the next topic in the next video.